So this is the lowdown on annuities webinar. This is probably one of my favorite ones to teach, just simply because I think there's a lot of confusion around annuities in general. And so, we're going to basically try to take a look at what are annuities and explain how they may or may not be right for you to utilize. Okay. I often will hear folks come in and say, Clark Howard, Dave Ramsey, my brother, my coworker, fill in the blank, says to avoid annuities. And, I'll admit, I'll be the first to say that annuities really, they're not for everyone, but that doesn't mean they are not for anyone. Clark Howard and Dave Ramsey, you got to keep in mind, they're trying to speak to a mass audience and basically apply financial principles and strategies to everyone in that audience, assuming everyone is comfortable with the same level of risk. There's one thing that I know for sure in financial planning and investment management. It's a very personal endeavor, and the same risk and strategies cannot be applied to every person who walks through my office doors. Not all annuities are created equal. And they can be used to accomplish different purposes. So today we're going to just kind of, we look to pop the hood on annuities, give you some insight into the world of annuities and how they might fit into your personal financial plans. So what we're mainly going to start with is, what is an annuity? An annuity is basically a contract between you, the owner, and the issuer, which generally is an insurance company. Okay. And the way that they work is you pay premiums or you deposit dollars into the account or the contract with the issuer. The issuer invests your money for you. The earnings accumulate tax deferred, and at some point the insurance company is going to pay out the principal and the earnings to you or even to your beneficiaries. Okay. Earnings are taxed as ordinary income when they're distributed. And one of the things I want to clarify, this, the second point here says that you pay premiums with after-tax dollars. That's talking about non-qualified money. Okay. But annuities can be used for IRAs or Roth IRAs or whatever the case is. And so the main difference between using non-qualified funds, which are non-IRA dollars, typically money that's kind of sitting in savings or CDs or non-qualified brokerage accounts, things of that nature. The main difference between using an annuity for those types of dollars versus for retirement, IRA, 401k dollars, etc., is simply just how taxes are going to be handled. Okay. On IRAs and such, you're going to be taxed as money is withdrawn, but everything is taxed. On non-qualified accounts, only the growth is going to be taxed. Okay. And so I just want to kind of clarify that. But as we're going through the presentation here, most of what's being referred to here is using after-tax dollars to fund an annuity, but the strategies can be used for IRAs, etc. Okay. Why might someone consider buying an annuity? Okay. Well, first of all, there are generally 4 parties to an annuity, and so we're going to start with that. The owner is usually the one who purchases the annuity. They make the deposits into the account. They name the beneficiary in the event of death, and the owner can make the withdrawals from the annuity or surrender it altogether. But they're the ones who generally makes the payments, and then they're also the ones who ultimately, if the annuity is going to be used for income, they would receive the income payments as well. There's 2 different ways. I'm going to touch on this now and go into more depth later, but there's basically 2 different ways to receive income from an annuity. One is through what's called annuitization. And the idea there is that it's very pension-like. it's going to pay you out, lifetime income. But what I want you to know about annuitization is you are losing control over those assets. Another way that you can generate income from annuities and more recent annuities is through the use of riders, where you can still generate a lifetime income, but you are not relinquishing control over the assets. You're not losing control. And that's a very distinct difference that I want to make sure you understand, is that idea of annuitization versus using riders. Okay. The second party to an annuity is the issuer, and that's basically the insurance company who accepts the premiums or the deposits. They invest them in accordance with the annuity contract. They promise to pay whatever benefits the annuity contract stipulates, and those benefits might revolve around income guarantees. They might revolve around principal protection or enhanced death benefits as well. Okay. The third party is the annuitant. They basically provide the measuring life of the annuity contract, or is used when calculating the income payments for either annuitization or the income riders. Typically, the annuitant is also the owner, but the annuitant is basically just the individual whose life is basically that the annuity is structured off of, whose life is the annuity based off of. Okay. And then the fourth party is the beneficiary. They're named by the owner of the annuity. They receive the proceeds of the annuity if the owner were to pass away, or receive any remaining benefits at the time of death, if applicable. Okay. So those are basically the four parties to an annuity. There's several reasons why someone might buy an annuity. I think the most basic one to start with is to gain tax deferred growth. So you can put money into an annuity and you're not taxed on that money until you make withdrawals from the annuity. And again, talking about non-qualified annuities, only the gains, of course, are going to be taxed as you withdraw them. You can use an annuity to save for a specific goal. It might be for retirement, it might be for legacy, or maybe you just like the specific growth strategy of the annuity. Okay. Annuities can be used to provide lifetime income. Okay, so they can supplement other sources of retirement income, giving, kind of increasing what your secure income is. Annuities can be used to hedge market risk or use a segment, what I would refer to as a segmented strategy for your portfolio, and we'll go into that in a little bit more detail later on. Annuities can be used to take care of age gaps. Okay, so if there's large differences in age between spouses, an annuity can help alleviate some of that. So for example, my wife is 5 years younger than I am. So women tend to outlive men. And let's say that she outlives me by 5 years. So if I were to retire at the age of 65, and she would be 60 at that point, and if she outlives me by 5 years, if I live to 85, I'm only going to get 20 years basically out of my nest egg. But she would need, if she lives to 90, she would need 30 years out of that same nest egg. And so an annuity could be a good way to protect the income for a longer period of time. Okay. In-service rollovers. So for folks that are still working and contributing to their company 401k plans or TSP or whatever the case is, in-service rollovers can be processed into annuities to protect the income that the assets will eventually provide at retirement. This is really popular. I do a lot of these right now with the market trading as high as it is. Annuities provide a good opportunity for us to protect those assets or protect the income that those assets are eventually going to provide. Income and savings provided by an annuity may help you remain financially independent, especially if you need higher withdrawal rates beyond 3 or 4% from your investments. So if your income needs require you to take withdrawal rates of 5, 6, even 7%, an annuity is something that you might want to consider, and we're gonna go into a little bit more detail in that as well as in upcoming slides. So there's a lot of reasons that an annuity might fit into someone's overall strategy or their financial plan. This is simply an illustration of the advantage of tax-deferred growth versus taxable growth over the years. And so what this is showing you is you make a lump sum, or someone makes a lump sum investment of $10,000 that will compound annually at the end of the year, and you're in a 28% income bracket, okay, tax bracket. And let's assume for this that the investments are earning 7% a year, okay? So if you invest that money in an alternative that's taxed each year, well, in 30 years, you're basically going to have $43,716, okay? But if that money was invested in a tax-deferred vehicle in 30 years, that would be $76,000, over $76,000 in the account. So, obviously significantly amount more than in the taxable account. And the reason that happens is because more of your money is working for you. You're not having to pay taxes on those funds every single year. And, Albert Einstein is reputed to have said, compound interest is the greatest mathematical discovery of all time, okay? And so while annuities earnings accumulate tax deferred, they are subject to income taxes when you withdraw them, okay? But, in the meantime, you're getting that tax deferred growth. Now, of course, annuities aren't the only choice out there that offer tax deferred growth potential. Retirement plans such as 401ks, individual retirement accounts such as IRAs, Roth IRAs, they do that as well. But there are some limitations that you've got to deal with when you're funding those types of accounts, okay? The next illustration is going to show you where an annuity might come into play. It's basically given the idea that, look, if you have a $500,000 account and a 4% distribution rate provides $20,000 per year as steady monthly income, most people will use that 4% withdrawal rate guideline. But what if you had an unexpected emergency that requires you to take out another $20,000, okay? And so you have now taken $20,000 as regular income, monthly income. You've also taken out another $20,000 for an emergency or maybe a trip or, whatever it is. And so now you've taken out $40,000 total for that year out of the $500,000 portfolio. This makes your distribution rate 8% for that year, okay? And so 8% is getting pretty rich. And if that were to occur, over the years, it would certainly deplete the balance of the account, rather quickly, okay? So where an annuity comes into play by using a segmented approach, you could position $334,000 into an annuity with a 6% distribution rate, and that $334,000 would give you the same $20,000 for that steady monthly income, okay? You can then use the other $166,000 for other purposes, like, if you're focused more on preservation or legacy, or you're just positioning it elsewhere for more of lump sum, for the lump sum withdrawals, the extra $20,000 for emergencies or trips or whatnot. And So the annuity becomes a good source to protect your income, but they're not really designed for, the big lump sum withdrawal. The other thing the annuity can do is it can protect your income from market losses as you approach retirement. So you can use a variable annuity for the stock portion of the portfolio, where you have protection with riders and you have the income guarantees. So you be more aggressive within the stock allocation through the annuity, and then you be more conservative outside of the annuity where you don't have, any of the guarantees of the annuity to fall back on. So again, annuities can be used to really structure or to segment your portfolio or your strategy. And when utilized correctly, they can be a pretty valuable tool. We're going to spend a little bit more time on this idea of withdrawal rates. I use this slide often in my presentations. I think it's really important for folks to understand so that you don't outlive your assets. Allocation and withdrawal rate is very important to making sure your money will last for as long as you do, okay? And so what this is basically showing, I want to explain what a withdrawal rate is. If someone had a $100,000 account, a 3% withdrawal rate would provide $3,000 a year. A 4% withdrawal rate would provide $4,000 a year, and so on, okay? So you can't expect a 10% withdrawal rate to last you 20 or 30 years using a conservative portfolio, okay? The more money you're taking out of your nest egg or your retirement accounts every year, the higher the withdrawal rate and the higher the strain on that portfolio, decreasing the likelihood that it's going to last you your entire lifetime. So what this chart is basically showing you is you can see over here on the left where there's different portfolios, 100% stocks, 75, 25, all the way down to 100% bonds. So what this is showing you is that if someone's going to take a 3% withdrawal rate, it doesn't really matter what you're invested in. Even if you have a 100% bond portfolio, a real conservative portfolio, there's a 100% chance that that money is going to last you, and even an 80% chance that it's going to last for 30 years, even with a 100% bond portfolio. Okay. Now, what you can see is obviously the higher, as you increase the withdrawal rate, the likelihood that that money is going to last over time is decreasing, and is decreasing more so with the more conservative portfolio that you utilize. So I've color coded this up at the top. If you're in a position where you've saved real well, you're able to just limit your withdrawals to 3 or 4% of the overall balances. You probably don't need an annuity. But if you're getting into that 5, 6, and 7% withdrawal rate where you need to generate more income off of your nest egg, the annuity basically allows you to do more with less as you're utilizing higher withdrawal rates. And so an annuity in that scenario is something that you should at least consider. You start getting into withdrawal rates of 8, 9+%. I mean, I would just say don't even go there, because obviously the likelihood that that money is going to last, over the long term is really low. Okay, but like I said, if you're needing higher withdrawal rates than 3 or 4%, then an annuity might be something that you should at least investigate and research and see if that's something that's a good fit for you. Okay. Sequence of returns is also very important to ensure your money lasts. And when you start taking steady income from your nest egg, what this is illustrating is the stock market on an upward trend as you start making withdrawals, or is it in a downward trend as you begin taking withdrawals? Okay. So what this is showing you, this is utilizing an example. It's just saying Jim is 65 years old. He has a $500,000 in his savings, and he invested this in an index fund that mirrors the performance of the S&P 500. So it might be like a Vanguard fund or an ETF or something along that line that is simply going to mirror the S&P 500. He's planning to withdraw 5% a year. So on 500,000, that would be 25,000 a year. And this is showing you in scenario A, the income distributions beginning in a down market that actually happened from 2000, 2001, and I think even 2002. And so this chart here in red on the right-hand side kind of shows you what happened in the early years as the market was going down. And as he takes 25,000 a year, his balance at the age of 83 is only $20,000. Okay. In scenario B, it's showing income distributions beginning in an up market based upon the same returns from 2017 to 2000. Okay, so all it did is reverse the order that those returns came in. It's the exact same returns over the exact same period of time. It's just reversing the order that they came in so that it's illustrating an upward market instead of a downward market. And you can see the reason that's important is because at the age of 83, his balance is 477,000 in that scenario versus 20,000 in the other scenario. And so keep in mind, you know, I've got it underlined here. In each scenario, the average rate of return is the same. It's 4.95% in both scenarios. The difference is the order that those returns came in. In scenario A, he's starting in a down market, and in scenario B, he's ending in a down market. Okay, so I would say in scenario A, he needed to utilize an annuity. Okay, in scenario B, he probably didn't need to utilize an annuity. The problem with both of these scenarios, however, is there's no inflation adjustment. Okay, he's taken $25,000 a year every single year, but that $25,000 at the age of 83 is not going to be the same $25,000 that he starts with at age 65. And so I would say these ending balances to some extent are overinflated in both scenarios. But you know, ideally you want to have some rising income in your retirement years to offset inflation. But you know, this is a good example where it's not just about what the average rate of return is that you get on your investments. It's about the order or the sequence of those returns and its impact on your portfolio and your income strategy. Okay. We're going to change gears here, and we're going to talk about different types of annuities. There's mainly 3 different types of annuities. You have fixed annuities, index annuities, and variable annuities. And we're going to talk about some of the differences between the 3. Okay. So with fixed annuities typically only allow you to make a single deposit or a one-time contribution to the account. Variable annuities will typically allow you to make multiple contributions. So you can be making annual contributions, you know, if you wanted to the account. Index annuities, some are single premiums and some are multiple premiums. It just depends upon the particular platform that you're using there. Fixed annuities will pay a guaranteed rate of return, while index and variable annuities do not. Okay. There are no cost or charges typically on a fixed annuity or even an index annuity. There's no what are called M&E costs, which is mortality and expense charges. On variable annuities, you will run into M&E cost. Okay. Optional riders. So what riders are basically what I would say are some safety nets or they provide guarantees on the annuity. Okay, so in a lot of cases, in the event that your investments don't cooperate, the writers will provide you some safety nets to fall back on. On fixed annuities, there's typically no riders offered. Okay, there can be riders on index annuities, and certainly there are riders available on variable annuities. Okay, so along with those riders, there are going to be rider cost, that add to the expenses of the account. Investment cost. There's typically no cost, investment cost with fixed annuities or index annuities. Typically, there are going to be investment cost within variable annuities. Okay. Downside market risk. Okay, so obviously on a fixed account, they're paying you a guaranteed rate of return, so there's no downside market risk. With an index annuity, there's no downside market risk. You're typically protected where you won't lose anything, but again, there's just no guaranteed rate of return on the upside. Okay. With variable annuities, you are participating in both, all the upside of the market and all the downside of the market. Okay. With fixed and index annuities, I would say, look, you're trying to compare those returns to what fixed rates are doing, CD rates, things of that nature, and you're trying to outperform, CDs and such. Okay. With variable annuities, you can compare those returns to mutual funds, ETFs, managed accounts, things of that nature. Okay. Guaranteed lifetime income only comes on fixed annuities through annuitization, and where on index and variable annuities, it can come through either annuitization or through the use of living income riders or benefit riders. Okay, I want to spend a little bit more time on that idea of annuitization. I know I touched on it early, but this is really an important point for me to make sure that you try to grasp and understand. When you annuitize an annuity, what you're basically doing is saying, look, here's my account balance, of $200,000, and the insurance company is going to give you, say, $10,000 a year. It's probably more than that. Let's say they're going to give you, $16,000 a year for the rest of your life. Okay. Here's where the risk comes in. It's for the rest of your life. So if your lifetime is only 3 years and you only got $48,000 back over that 3 years and you passed away, the insurance company is going to keep the remaining balance of the account because you have relinquished control over that annuity. Okay. Through annuitization. Now, there are options where you can set up some survivorship options and so forth, but I'm trying to keep things relatively simple right now. Okay. So again, you've relinquished control. Now, if your life is 20, 25, 30 years, you're going to get more back than obviously what the account balance is in that scenario. Okay. The difference with a rider is that you don't have to relinquish control over that account. And so the rider would probably give you less income, than annuitization. But even if you were to pass away in the short term, your beneficiaries will still receive the remaining balance of the account. Or in the long term, if there's a balance there to be passed on as legacy, your beneficiaries will continue to receive that, because you didn't annuitize, you didn't relinquish control over the assets. So again, that idea of annuitization is very pension-like. Once you pass away, it's done, whether you got all of your benefit or not. Okay. So hopefully that brings a little bit of clarity to annuitization. I'm not a huge fan of annuitization. I would probably use it as a last resort for clients. But the insurance company is basically betting that you're going to pass away sooner, and you're kind of betting that you're going to live longer. I would say, look, you can use riders and just kind of remove the bet entirely. Okay. So anyway. Some of the differences, well, we're going to talk about some of the similarities first, but there's a lot of similarities to fixed and variable annuities. Mainly, they involve the same four parties. You have the owner, the issuer, the annuitant, and the beneficiary. Both offer tax-deferred growth potential on the investment. Both offer the freedom of discretionary withdrawals. Both can be annuitized for income in the distribution phase. And the earnings on both are basically taxed in the same fashion. They're taxed as you make withdrawals, okay? But there's some very significant differences between fixed and variable annuities, okay? Fixed annuities, as we mentioned earlier, will provide a guarantee that the principal you invest will be returned to you. And they will also guarantee a minimum rate of return or minimum amount of interest on your investment, okay? Of course, all guarantees are subject to the claims paying ability of the annuity insurer, but fixed annuities, for the most part, they're very similar to a CD with a fixed rate of return, okay? You sign up for a specific term, and during that term, they're going to give you a guarantee, 1%, 2%, whatever the case is, okay? Now, this is not generally the case with variable annuities, okay? Variable annuities, the insurer basically is not offering you any guarantees. You are typically assuming all of the risk related to the performance of the underlying investments, and any earnings are solely dependent upon those investments, okay? So you could have some negative market performance that affects your principal or your initial investment. But what you're looking for through variable annuities is you're looking for higher average returns over time. There's a risk-reward relationship. You're assuming more risk and expecting higher returns as a result, okay? In a fixed annuity, you cannot choose how your money is invested. Instead, your earnings are based on a fixed interest rate declared by the insurance company, as you sign up and open the account. There's generally no fees on a fixed annuity, okay? On a variable annuity, you are going to have some fees and charges due to the investment options that are there, okay? We're going to take a look a little bit closer into how annuities might compare to 401ks and IRAs. Through annuities and 401ks and IRAs and Roth IRAs, you do gain tax-deferred growth. The contributions that you make to 401ks and traditional IRAs, those contributions are tax deductible or pre-tax contributions to lower your income for that year, okay? As far as unlimited contributions, this is where you start running into some limitations with the 401ks and IRAs and Roth IRAs. There's a cap on how much you can contribute to those accounts every year. So if someone has, $100,000 that they had accumulated in their savings or CDs, or maybe they inherited money, you're not going to be able to plop all that money all at once into IRAs and Roth IRAs and such, okay? There is no cap on how much you can put into annuities, okay? Typically, annuities will offer a guaranteed minimum death benefit. So, for instance, if someone had put in $100,000 into a variable annuity, let's say the market dropped and they lost 10%, their account balance was $90,000 and they passed away, their beneficiaries may very well, still get the $100,000 that they started the account with. Required minimum distributions. Those are now to start at the age of 72. The only place that you have to worry about required minimum distributions are from pre-tax 401ks and traditional IRAs. You do not have to deal with RMDs from annuities or Roth IRAs. Tax on withdrawals. On non-qualified annuities, you are going to be taxed on the growth, okay? But you're also going to be taxed on the growth first, okay? So if you put 100,000 that grew to 120, that first $20,000 that you take out is going to be taxed. On 401ks and IRAs, everything is taxed because all of those accounts were funded, you know, with pre-tax dollars or dollars where you took a deduction. Roth IRAs, that money ideally, you know, would not be taxed as you pull it out because you funded it with after-tax dollars. Annuities are the only investments out there that can give you that guaranteed lifetime income, again, either through the use of riders or annuitization. The other thing that's nice about annuities when you're planning, they're very predictable because of the riders. You know, I could sit here and forecast out for someone, you know, if you put $100,000 into an annuity today, how much income will that provide you as a minimum income in 5 years, 10 years, etc. It can perform better than that, and it may do better than that, but I can give you a minimum guarantee of what that will do, you know, in a certain period of time. So from a planning standpoint, it's really nice. Annuities are very predictable in that regard. Fees and charges, I mean, quite honestly, guys, any place you put your money, if you're assuming any type of market risk, you're going to have some level of cost associated with your accounts, okay? You know, typically the only place that you're not going to run into fees is if you're investing in, you know, fixed accounts like CDs or even fixed annuities, things of that nature, where you're not assuming any type of market risk. I think there's other risks there. I mean, you've got inflation risk. You're safely losing money every year based upon the current fixed rates, right? If you know, if you're only getting 1% someplace and inflation is 2.5%, 3% average, you're safely losing money every year. But you know, any place where you're taking on some level of risk or having some guarantees in place or whatever, there are fees associated, you know, with your investments. Okay. This is just showing, you know, different ways to put money into an annuity. There's basically two distinct phases to an annuity contract. The phase where you put money in is basically called the accumulation phase. And the phase where you take money out is called the distribution phase. So in the accumulation phase, you can choose to pay premiums in one of two ways. You can pay in a lump sum, meaning, you know, you plop in X amount of dollars all at once. This happens in a lot of cases through rollovers or moving IRA assets or money from CDs and money markets, things of that nature. But you're just basically making a one-time deposit, okay? You can also make a series of premium payments over time. So these payments can be made in equal amounts at equal intervals, or you can make payments at variable amounts at irregular intervals, okay? You know, depending upon the terms of the annuity. So typically it's variable annuities. There are some index annuities that will allow you to make multiple deposits, okay? I know we touched on that a little bit earlier. Immediate annuities, so you can put money in an annuity and let it earn interest, or you can begin to receive payments almost immediately through an immediate annuity. Now, annuities are classified as either immediate or deferred, and these are simply, these terms simply refer to when the distribution phase of the annuity begins. So on an immediate annuity, you convert a lump sum of cash into an income stream, again, through annuitization. Again, not a huge fan of that, but they are typically purchased with a single payment, and the distribution period usually begins within a year of purchase, okay? Again, made with a lump sum deposit, and you know, those withdrawals come out within a year, okay? Deferred annuities can be purchased with a single lump sum payment or a series of periodic payments. The distribution period begins sometime in the future, which allows the earnings to grow tax deferred, and but you can make withdrawals anytime. That idea of the distribution phase is really talking about income, and so there's different types of deferred annuities as well. Okay, and so we're gonna talk a little bit about that. But with a fixed annuity, you make a premium payment to the annuity issuer. Your payments are placed into a general account. You earn a fixed rate of interest declared by the annuity, while the company guarantees the return of your principal and the minimum interest rate. Okay. Any earnings on the money you invest do grow tax deferred. You don't pay taxes on the earnings until you take withdrawals from the annuity, either through, just a withdrawal or by annuitization. Okay. There's different withdrawal options that the annuity will offer you. Okay. Sorry, skipped ahead a little bit. Try this again. Those withdrawal options will the insurance company is making those withdrawal options back to you through steady income or to you or your spouse. Okay. And then most annuities will provide the death benefit upon your passing, either of the account value, once you pass away. Okay. With a variable annuity, they work similar to fixed annuities, except you can invest your premium payments in a wide variety of investment options called sub-accounts. Okay. Generally, you make deposits or premium payments to the insurance company. You can allocate your premiums to a portfolio of sub-accounts that are invested in stocks, bonds, or a combination thereof. And those monies grow tax deferred along the way. And then once you start taking withdrawals for income, you're receiving those payments back to you for income purposes, and then you're paying taxes, as you take the income. Now, one of the things to keep in mind with annuities is with those withdrawal options, if you take those withdrawals prior to age 59 and a half, you run into an additional 10% early withdrawal penalty, much like you would on an IRA or 401k when you're taking withdrawals prior to 59 and a half. So, annuities probably aren't the best idea always for younger investors, because that's money that's being, absolutely tied up until 59 and a half or later. Okay. Variable annuities will typically offer a minimum guaranteed death benefit that would go to your beneficiaries. This can be in the form of a lump sum death benefit, or it can be in the form of steady monthly payments, however you select. Okay. With those guaranteed death benefits, annuities are somewhat considered a form of insurance. And so it's not surprising that both fixed and variable annuities provide a guaranteed death benefit when you die. So if you die before the annuity is annuitized, your beneficiary will generally receive 100% of the premiums that you paid, minus any withdrawals you've taken. Okay. You can also structure the account to pay your beneficiary the cash value of the annuity at the time of death, or you can have what are called structured payouts, where if you've got, a beneficiary that you don't feel is the most responsible with money, you can kind of structure those payouts to pay out, X amount of dollars over a number of years. Okay. Now, if you die after annuitization, say you've annuitized the account and then you pass away, if you selected some survivorship options with your annuitization, then those survivorship options will pay out. But if you didn't select any type of survivorship options, where that income continues on for a period of time, then obviously the account is done, because again, with annuitization, you've relinquished control on the account. Okay. As far as annuity fees and expenses, some fixed annuities I told you before, there's no, typically on fixed annuities, there's no cost or fees. Um, Sometimes there may be an annual contract fee, I'll say like a maintenance fee, that is typically waived with a certain deposit into the account. So, it might be if you have $10,000 that you deposited, they've waived that fee. But there's no types of expenses or annual expense typically on fixed annuities. Um, on on variable annuities, the fees that you run into, you have, again, the contract fee may be waived, based upon the account balance. You typically will have a mortality and expense charge. There can be rider charges as well. And then you also have cost associated with the sub accounts or the investment options that you utilize. So a lot of times when you hear people bashing annuities, a lot of times it can be associated with the cost associated with the annuities, because they can certainly get up there. But it's because you're putting an insurance wrapper around your investments or around your income that, say mutual funds or a 401k or something along that line can't necessarily provide you. Okay. Surrender charges. Okay. So what surrender charges are is if you sign up for an annuity that has a term associated with it. It could be like a 5-year, 6-year, 7-year term, and you pull that money out, all of the money out before the term is up, they're going to penalize you for taking that money out of the annuity before the term. Now, with annuities, you typically have what are called free withdrawal amounts, where you can take out 10% of the account balance without any penalty. So there are some liquid options there, but if you take all of your money out all at once before that term is up, you're going to run into some surrender charges. And so you've got to be aware. They're pretty expensive. You've got to be aware of what you're signing up for. Okay. Taking money out of an annuity, generally you can take money out of an annuity in one of two ways. You may withdraw money at your own discretion. Again, keep in mind there are penalties if you take that money out before 59 and a half. But when you take withdrawals out, they can be taken out either at regular or irregular intervals, and they may be either fixed or varying amounts. Okay. Also, withdrawals are going to, again, may be subject to surrender charges during the early years of an annuity if you exceed the free withdrawal amount. So if an annuity gives you a 5% free withdrawal amount or a 10% free withdrawal amount, if you take out more than that, you're going to get penalized. Okay. So annuities are not designed, they're not friendly for big lump sum withdrawals. So if I'm using an annuity for clients, I want to make sure that we have another place to go to for those big lump sum withdrawals, because annuities aren't going to be real friendly for that. Now, again, at some point, you can elect to annuitize the annuity, which is the term used when you convert the annuity to periodic income payments. Depending on the annuity, you can elect to receive a fixed or variable amount, which you can receive either monthly, quarterly, semi-annually, or annually. You can elect to receive these payments for a fixed time period, for your lifetime, or for the lifetime of another person, like a spouse. Okay. You can take withdrawals based upon the use of the specific riders. So keep in mind, there's typically additional cost associated with those riders, but those riders do not require annuitization. Okay. Unlike 401ks and traditional IRAs, non-qualified annuities are not subject to required minimum distributions that start at the age of 72. So if you don't need the money from an annuity, you can leave that money in the growth phase of the annuity and gain tax deferred growth for the rest of your life. Okay. So, again, it can turn into a long-term tax deferred account for you. Okay. Again, we're going to hit on the idea of annuitizing the annuity. Generally, annuitizing converts your annuity into a stream of income payments. With a fixed annuity, the current value of your annuity is converted into a stream of guaranteed payments, and you'll receive periodic fixed payments on a schedule of your choosing. Okay. With a variable annuity, you convert the current value of your account into a stream of fixed payments, just like a fixed annuity, but you can also receive variable payments as well. Okay. So, you know, you might have variable payments if the investments are doing well. You know, you might get increased income based upon the underlying performance of the investments. Okay. Once you annuitize, that is typically an irrevocable decision. Okay. You can't really change your mind. So once you annuitize, you can't take what I would say is an additional lump sum withdrawal. You're just on that schedule of monthly or annual income, okay? Because again, you've relinquished control on the account. So there are some factors that go into what those annuitization payments would be. Obviously, the cash value of your account is going to determine how much income the annuity is going to provide. The performance of the underlying investments with variable annuities is going to determine how much income the annuity is going to provide. Age and gender of the annuitant, okay? Again, women tend to live longer, and so they're going to get a lesser income amount than their male counterparts given the same age, okay? The payout option you choose. So the lifetime payout option is typically the highest payout option because again, that lifetime could be 3 years, if you were to pass away. It could be 30 years based upon, whenever you pass away. There are some period certain options that you can choose that would be like a 10-year period certain or a 20-year period certain. What that means is if you were to pass away in 3 years and you had a 10-year period certain, it will still pay out for the remaining 7 years to your beneficiaries. Okay, but the payout option you choose is certainly going to affect the income options or the income amount when you annuitize. The different annuity payout options, I kind of touched on those already. Payments for life, period for a specific period of time called the certain options. There's a refund option. The refund life option provides you with payments for life, but if you die, you receive the total balance of the annuity. The remaining balance will be paid to your beneficiary either in a lump sum or installments. The joint and survivor option provides income for 2 persons. The first one, and then a second person, when the first person passes away. So when the first person dies, the second person would continue to receive the payments or some portion of the payments for their remaining lifetime. Okay. It is important to remember that while both fixed and variable annuities offer guaranteed fixed payment options, variable annuities offer payouts that will fluctuate with the performance of the underlying sub-accounts. And so, again, your income payments may be higher, if the investments perform better, okay? But if the investments perform poorly, this could result in smaller income payments as well, okay? We're going to talk about some common annuity riders. And again, I want to emphasize that these riders do not require annuitization. Aside from the common features of each type of annuity we've discussed, annuity issuers will frequently offer additional options in the form of riders. And most riders are available. They're going to have some cost associated with them that can be as little as 0.1%. To as high as 1% or more of the annuity's value each year. But riders and their availability will differ from one insurance company to the next and depend upon the type of annuity that you're using, okay? Common fixed annuity riders will waive surrender charges, allowing for access to cash value for needs like long-term care, disability, unemployment, or if you suffer from a terminal illness or life-threatening illness, okay? A lot of times those aren't even referred to as riders. They may just be called waivers, where you can basically pull your money out under certain circumstances without any penalty to you, okay? Common variable annuity riders would include riders that give principal protection if the annuity falls below the amount due to poor investment performance. You may be able to access this amount either through periodic withdrawals, or they may just give you a lump sum amount after a stated number of years, okay? You can also receive guaranteed income for a fixed period of time, or your life, or for your life, you know, without the use of annuitization. Okay. Immediate annuity riders offer features including access to the balance of the immediate annuity in a lump sum. That would be the commuted payout rider. They will increase payments each year to offset the effects of inflation. So that would be a cost of living benefit rider. Or the assurance that you don't live long enough to collect payments at least equal to your premium, then the balance will be paid to your beneficiary in a lump sum. That's basically what's called a cash refund rider. Or if it's a series of payments, it's an installment refund rider. Okay, so there's different riders that go along with different types of annuities, okay? The federal income tax consequences are essentially the same for fixed or variable annuity withdrawals. The portion of any withdrawal or payout that is considered growth, that money is going to be taxed first at ordinary income. Generally, withdrawals are considered to be coming from the growth of the annuity before the principal. So once you get into the principal of your annuity, you know, you probably don't need to have withholding done any longer, because you've now paid taxes on the growth and now you're into the principal, okay? If you annuitize, however, each payment is considered to be partially a return of your principal and a partial distribution of earnings, okay? So that would be one of the advantages with annuitization, is that your growth isn't taxed all up front. It's kind of split between, that annuity payment is split between both your growth and your principal. But in addition to the ordinary income tax on the earnings portion of withdrawal, there is a 10% premature distribution tax if you're taking those withdrawals prior to 59.5. And, you know, we've talked about that before. So annuities have some of the similar characteristics as IRA accounts, you know, when you're taking that money out, you know, prior to 59.5, okay? Just some things to consider with variable annuities. You know, they're long-term investments, you know, suitable for retirement funding. You know, you're subject to market fluctuations, that type of thing. They are sold by prospectus, and so you should consider all the risk objectives, charges, etc., through the prospectus. Okay. When should you get out of an annuity? You know, a lot of times I'll have folks come in and they've got old annuities, you know, they've had for maybe 15, 20 or longer years. And, you know, it does make sense at times to get out of an annuity. Now, you got to keep in mind, you can only get out of an annuity if you have not annuitized it. But there's a lot of reasons someone might look at getting out of an annuity. You know, if you have planned initially to generate income from your annuity, but no longer foresee that need, you know, you may want to look at changing annuities or leveraging the funds for another purpose, like legacy or long-term care, or, you know, survivor income or something along that line. Okay, so if the purpose for the annuity has changed, you may be able to provide yourself with more income through another annuity. Okay, so if you haven't annuitized the annuity and you're using income under the rider stipulations, you may be able to provide additional income through another company and the use of their rider. Okay, so to increase the income would be a reason to change annuities. If you're paying for riders or benefits that no longer apply to your goals, you would want to change the annuity to try to lower cost. When your life expectancy prevents you from benefiting for the riders. For example, if it takes too long to recapture the balance with steady income, then you might change strategy. For example, if you're 75 years old and it's going to take you 20 years to get the account value returned back to you, you should probably consider getting out. Likelihood is that you're not going to live long enough for the riders to really pay out for you. Okay. Now, if it's only going to take 10 years to get your money out, you might want to stay in the annuity. Some contracts force annuitization at a certain age, like age 85, 90, 95. So if you're being forced to annuitize an annuity, you might want to get out at that point. If you want to change the growth strategy, or maybe your risk temperament has changed since originally opening the annuity, that would be a good reason to get out. If you want to start unwinding the tax deferred growth of the annuity, okay, remember the growth is generally taxed first as income, but if you gradually want to start unwinding that tax deferred growth, that could be a reason to get out of the annuity. If you want to lower your all-in cost, okay, so keep in mind, if there's M&E cost, there's rider cost, there's investment cost. If you want to lower, the all-in cost, that would be reasons to get out of the annuity as well. Okay. I want to show you a short video for some of the stuff that we do here at Wright-Patt. I put a lot of emphasis on financial planning because what a financial plan will do is it will give us a probability of success as to what's the likelihood that you're going to beat all of your goals during retirement. And if I've got someone that has a high probability of success, my recommendations are going to be a whole lot different than someone that's got a low probability of success. So I want to show a video to you that will give you a little bit of insight to the financial plans that we are capable of putting together for clients here at Wright-Patt. If you're going to go ahead and exit, or whenever you do exit the webinar, just take a minute to complete the brief survey. I think it's only 4 questions. So if you wouldn't mind completing the survey, I'd appreciate it. But I'm going to go ahead and just kind of show you this video. It's only a few minutes, so we'll go ahead and get that started.
Life isn't static. Life changes, and it's important to be prepared for those changes. Welcome to Money Guide Pro, the groundbreaking financial planning software that sparks the important planning conversations and helps you create your own personalized plan for your life and retirement. The experience is simple. We start with the easy stuff, your personal information, then move to the exploration of your personalized goals, which are the heart of a quality financial plan. Your goals are divided into needs, wants, and wishes. Not all goals are equal. This will help us prioritize what is most important to you: buying new cars, paying for college, providing care for a loved one. We'll address each of these and learn what is important to you and why. We also address those items you may not be thinking of. So it's important to include healthcare costs into your goals and discuss longevity to make sure you're protected. Next, we evaluate the resources you have available to fund your goals. We review everything from retirement income, pension and Social Security, to investment assets and insurance, or other assets such as a home, rental property, or business and stock options. Do you have liabilities? We can enter those too, and then view your net worth statement. We'll discuss risk and decide how much risk you're willing to take. You have one question: can I fund all my goals without running out of money? We provide an easy to understand result called the confidence meter, which shows you your probability of success. If you want to see more detail within the result, you can drill down into each individual trial or view a year-by-year breakdown. The plan may not end up in the confidence zone initially, so we'll make recommendations to get your plan into the confidence zone. One of the most interactive tools, the Play Zone, allows you to instantly see how changing some of your expectations, when to retire and how much to save, can impact your plan. We can also test the effects of risks outside of your control. Most importantly, your financial plan isn't static. It will adjust with you over time, and we will continue to review and make improvements as your life changes. You'll be able to view your plan through easy online access and see your dreams come into reality.
All right, guys, that's all I have for today. I don't see any questions, and so this concludes our webinar. And here's my contact information if you decide you want to reach out or have other questions offline. Thank you.